In commercial property, a discounted cash flow, or DCF, is used by property investors to value investment opportunities. If you studied real estate at university, you may have come across discounted cash flows as a valuation method. But the reality between what you learn at university versus what they do in real life is quite different. In this video, we'll break down what a DCF is and how it's used by investors and valuers to calculate a property's value. So first of all, let's define what a discounted cash flow actually is. The discounted cash flow is a valuation method used to estimate the value of an asset based on its expected future cash flows. The key principle behind DCF is that money today is worth more than money tomorrow. This concept is called the time value of money. This is done by taking the projected future cash flows of a property and then discounting them back to today's value using a predetermined discount rate. We start with the projected cash flows. This means forecasting all the expected income and costs relating to a property, including rent, service charge, and capital expenditure, based on assumptions chosen by the investor or the valuer. We then use the discount rate to convert each future cash flow into its present value. In valuations, the discount rate is also referred to as the required rate of return, which is the time-weighted annualized return on capital that investors require to make an investment worthwhile based on the risk profile of the investor. In general, higher levels of risk will result in higher rates of return, and therefore a higher discount rate, while lower levels of risk will usually result in lower required returns and therefore lower discount rates. Adding together all of the projected future cash flows discounted to today's value will then give us the upfront capital amount an investor would be willing to put into a deal to hit their required rate of return. An investor will use a discounted cash flow and their target rate of return to calculate the investment value of the property. A valuer will use a discounted cash flow and the market's required rate of return to calculate the market value of a property. Let's look at an example of a discounted cash flow analysis from the perspective of a valuer. Our example property is forecasted to generate £150,000 per year of net income for the next 5 years. After 5 years, our terminal value is calculated using a capitalisation rate of 5% to give a value of £3 million. The required rate of return or discount rate is 10%. For each of these periods, we need to discount the cash flow back to today based on the discount rate and the number of years that have elapsed from the start date. The formula for this is the annual cash flow divided by 1 plus the discount rate to the power of the number of years that we need to discount it by. So in this case, in year 1, we need to take the $150,000 of net cash flow and divide it by 1 plus 10% in brackets to the power of 1. Which gives us just over $136,000. In year 2, we need to take the net cash flow of year 2, which in this case is the same $150,000, and then divide it by 1 plus 10%, but this time to the power of 2, which gives us just shy of $124,000. And as you can see, this $150,000 amount reduces in each year of the cash flow as the discount rate is applied for each additional year. In the final year, we include the terminal value within the cash flow. And you can see that the $3.15 million in 5 years' time is actually worth just under £2 million in today's terms using the 10% discount rate. From here, to finish our DCF analysis, we need to sum all of these discounted cash flows to calculate our net present value, or NPV. What this tells us is that based on these cash flows occurring at the end of each year, the market value of this property is $2.28 million, assuming purchase costs of 6.8%. In Excel, we can also use the inbuilt NPV function to calculate the net present value of the cash flows without having to individually discount each cash flow. To do this, we use the NPV function using the discount rate as the rate and selecting the cash flow line as the values. You'll see that if we apply the same 10% discount rate to the same cash flow, we end up with the same net present value and the same market value of $2.28 million. From an investor's perspective, we can use a discounted cash flow analysis to work out the price they'd be willing to pay for a property, also known as the investment value or worth, that would enable them to hit their target return. An investor's target return or internal rate of return is the discount rate at which the net present value of the cash flow is equal to 0. So we can either use the NPV function, as we did in the previous example, to back solve the value based on a target rate of return, or use the IRR function to calculate the return based on the initial value. One thing to note when using the IRR function is that the initial capital outlay must be in period 0, unlike the other examples where our first cash flow period was at the end of year 1. Investors use the IRR function as it allows them to take into account other factors that will impact the cash flows, such as debt, and it allows them to make adjustments to their underlying assumptions and run sensitivity analysis to help them determine their offer price and risk appetite for a particular deal. That's why when you open up investment or development models used by most commercial property investors, you'll see that the IRR is one of the main focal points or metrics that they refer to, and you won't necessarily see a net present value calculation. In more sophisticated models, you'll also see these cash flow periods split out quarterly or monthly to allow for greater detail in the investor's analysis. To sum up, a discounted cash flow takes the target annualized time-weighted return on capital invested and then applies this to each projected cash flow, factoring in the amount of time that has elapsed since the initial period. The sum of these discounted cash flows represents the upfront capital, including costs, needed to hit the target return. If you want to learn how to do discounted cash flow analysis in more detail, make sure you check out our all-in-one training platform, the EiP Academy. When you join the EiP Academy, you'll get instant access to all of our expert-led courses, downloadable templates, resources, and real-world case studies, plus a supportive community where you can ask questions and get expert feedback whenever you need it. Whether you want to land your first investment role, make yourself more employable, or stand out as the sharpest analyst in the room, the EiP Academy will fast-track your progress and set you apart. And if you enjoyed this video and want to see more content on financial modelling concepts like this, make sure you hit the like button and let me know in the comments what other topics you'd like us to cover on the channel. Thanks so much for watching. Subscribe if you haven't already to see more videos like this every week, and I'll see you in the next one.